Welcome to the daily update, where I'll go over the action in the market from Monday, August 19th, and then we'll see how things look for Tuesday, August 20th. We're below average with volume, not a real surprise. Middle of summer, a lot of people are on vacations, but we continue to go higher. Now, after Friday, we had a pretty short list in the intermediate term as far as extreme positive readings. That list is getting quite a bit longer now. We already have kind of a long list in the short term. It could suggest that we're getting a little tired as we continue to go up, but it can also suggest that we're still seeing good momentum. There was a little bit of a dip right after the open on Monday, but buyers quickly came in and just started to push prices up. So we are full-blown positive now, but a little overextended to the upside. Things are looking good, but we're also coming into, at some point anyway, a period of historical weak seasonality. We'll have to see if it plays out that way or not. I do have a thing called the SPXInvesting Program. There are links below this video and all the videos that I upload that will take you to the website, as well as some videos that tell more about the program. One thing that I have changed after some feedback from members is I'm delaying making the weekly videos public. If you want to have early access to the daily video or to the weekly videos right after I record them and upload them, please become a member. Check that out. You get access as soon as they're available. But what I'll be doing now, or what I already do with the daily video, is it becomes available when that day closes. So Monday's video became available right at the close for Monday. I'm delaying the weekly videos until Sunday evening US time, depending on where you're located. If you want to have early access to those, usually I have the weekly video and the intermarket analysis video on Saturday. Then I prepare the deep dive video, the what to watch video, and other videos. I think that's about all that I prepare. I lose track after a while. Those will be available starting Sunday evening, but they're available earlier if you are a member of the program. And it's free for right now. It's probably going to stay free for a little while. I had been planning on locking it down in August, but due to some logistics and upcoming travel plans, I'm deciding to delay that for a little while longer at least. So feel free to check it out. It's just something that will add to the information that I already give here. There are also additional videos that I post on the website that I don't post on YouTube or Rumble. Okay, and the daily video is the real foundation of the analysis that I do. All of the weekly videos, there's a new supplemental video that I just uploaded on Monday. You can check those out. You have access to those, but everything feeds into the daily video. All right, let's go back and talk about what happened. We had a higher open. Futures were fairly positive, not any real strength. It looked like we just had a slight bias to the upside. And then right after the open, which is fairly common, some people over the weekend decided to get out. So we dropped slightly below the unchanged level, but not for very long. And then we were able to climb all the way back up to R1 at 55.59. We continued to climb. We got above R1. We actually went above R2 at 55.84, and we closed right at the high for the day. We were up 0.97% on below average volume. Again, a little bit of a concern. We have to ultimately follow price, but at the same time, to see price going up pretty much since this bounce, going back to, well, about August 6th, going up from here, we've seen that on a decrease in volume, and that is a warning sign, but we're still going up nonetheless. We are positive in the short, intermediate, and long term. We're looking a little extreme in the short and intermediate term now, even a few indications in the long term, which also could suggest good momentum. We want to keep an eye on all the different geopolitical things going on. Some comments. We're back above 5,600 with the S&P. I actually made a post on the website. Just watch that 5,600 level. Didn't seem to offer too much in the way of resistance. Usually these round numbers, They're not necessarily technical, but they're psychological. And the market will start to fixate on that. And there are also strike prices, if you follow options very much, that suddenly everything changes when we go above 5,600. There's a whole lot of options that are now in the money that had been out of the money before. And the financial media, oh yeah, S&P's back above 5,600. It's just a nice, easy, round number for them to be able to report. We're still below 15 with the VIX. Back at the beginning of August, we actually spiked above 60. We closed above 60, but we were able to get back. We went above 65 there for a while. Here's our short-term list, and it's still kind of long here. We have the advanced decline ratio, the shorter-term version, both based on price and volume. That's looking extreme. The 20-period moving average of the S&P 500, the rate of change going back 5 periods and 10 periods now. The Stoke RSI, Williams percent R, CCI 14, and I should have included the 20. That's now on the list as well. The stochastics in the short and intermediate term, the force index, and then the boom indicator. We're still kind of far away from that 20-period moving average. Now, we just had one thing on the list after Friday. Now look at the intermediate term list of extreme readings. The CMB composite, which was on the list before, but now we have the Connors RSI back on there again. The S&P McClellan oscillator and the Swenlin trading oscillator based on volume. It's not quite there based on price. The PMO studies, just one of the 3 studies that we look at, are looking rather extreme. The Sean trend meter, the Chaikin oscillator, which is one of our smart money indicators, and the ultimate oscillator. In the long term, this has been on here for a while. The rate of change going back 200 periods. Now, not in a bigger picture, and I should probably break out a chart and show you that. This is just relative to what we've seen over the last year to 2 years on this particular chart. And then we're looking a little extreme. We already had been with the 200 period simple moving average. Now we're starting to see the 150 get a little extreme as well. And I haven't changed the scenario. We'll have to see if that's going to change this week. Not much in the way of economic reports that'll be coming out, but Chairperson Powell will be speaking in Jackson Hole. And if you remember a couple years ago, the market was really liking things until he gave a speech and said some things the market didn't like, and we really tanked after that. We don't know if something like that's going to happen now, but the market's really going to be paying attention to what he says. And there is 100% probability that the Fed will cut rates in September. We just don't know how much. Now, since the economic reports are showing that the economy is not necessarily falling apart, it had been about a 50-50 chance between 0.25% and 0.5%. Now that the economy is looking at least okay, that's really drifting back to a 0.25% cut in September. The dollar was down and interest rates were also down. We still continue to fall with that 10-year yield at 3.87%, where after Friday we were at 3.89%. And we're still inverted with the yield curves. We get kind of close at times with that 10 to the 2-year, but it hasn't gone back to being normal yet. Sentiment is still negative, but we're kind of going with this. We had got down to that 25 level, even dropped below that, and we're inching our way back up as people are feeling more positive about things. We're currently coming in at 41, where after Friday we had been at 35. Now we're still negative, but we had gone extreme negative. If we tick up a few more points from here, we'll actually go back into neutral. And we are positive with our trend. The green line last week crossed above the red line. That's why we default to positive with the ADX chart. But we're still going down with the ADX itself as it's repositioning itself after this crossover. But we're still above 20. That's a static number that we use to determine if we're trending or not. The bias is positive with the up day, and the momentum over the last number of days also continues to be positive. We just had one economic report, and some people don't put a lot of importance on this. Other people do. It's because a lot of the pieces that come together for this report are known before the LEI is even released. But I like to look at it. I have a couple of charts to show you after this. We were down 0.6%, where they expected us to be down 0.3%, or last time we were down 0.2%. Is suggesting some economic weakness. So here, this is coming from the Conference Board website. It says the LEI's annual growth rate has stabilized, but remains negative, suggesting downward pressures on economic activity ahead. We are following the light blue line here, where we had been coming back up, but now we're slowly starting to turn back down. They call this stabilized. I call this starting to decline again. And then here's another one. When we drop below this red line here, that's usually what signals that we may go into a recession. Well, that hasn't happened, at least as of yet. And of course, there's a lot of folks that say we will go into a recession, other folks that say we won't. We don't take either side, at least I don't. I just look at the charts. And on the website, periodically, I do a supplemental video that talks about, okay, here are the charts that suggest we might go into a recession. Here are the charts that suggest we won't. And these are the things that we follow. And instead of just coming to some conclusion that yes, we will, no, we won't, I just look at the data and then we'll just adjust accordingly if that ends up happening or not happening. All right, Isabel Net, and now I completely disagree. Personally, I have blown this out of the water for over 3 decades of being involved in the market. That's because most people suck at trying to time the market. And so they don't learn technical analysis. And there's people that think technical analysis is just a joke. Well, if you watch these videos for any length of time, there's nothing better to really evaluate where we're at with the stock market and what's actually happening. But those people that try to time the market, they usually do it by emotions. And when they do that, they're bad because they're using Las Vegas tactics instead of looking at charts, making decisions, doing things even when it doesn't feel like the right thing to do. And that's why you have dollar cost averaging or longer term investment in type strategies, which work for probably most people because you can still build up a nice portfolio while at the same time not having to be really actively involved. Well, if you were fully invested during the whole time, you would do better. But and then you missed the best 10 days, 20 days, 30 days, 40 days, blah, 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 blah. Anyway, if you agree with this, then please stick with the long-term type strategy that you use. If you think you can do better than this, I've done massively better than this over the decades. It takes more work, it takes dedication, it takes more knowledge, and it has to become a real commitment. But don't we owe it to ourselves to do the best that we can when it comes to this? So anyway, that's kind of where I come out here. And I'm not necessarily stating an opinion about this. I'm saying this is fact that you can outperform what this chart says. But if you're not willing to sacrifice and dedicate yourself to doing that, then go to the fully invested type of strategy. In the long run, it will be about as good as you can do. Or a variation of that is the dollar cost averaging, where you just add money to a portfolio every month or every week or however often you do that. All right, central banks hoard gold at the fastest pace on record. These are all the central banks together. And could this be signaling some kind of trouble? Now, I've heard some reports and other reports saying that the Fed is really not buying any gold right now. And why are they not doing that? If that's even true. So we get conflicting information. But usually when they're buying an awful lot of gold, this is a protection against inflation. It's also also a protection against insanity. We got a lot of crazy things going on in the world right now, and gold will always have some value. It always has, and it probably always will. Then looking at short interest, and now there's 2 ways to look at this, and you can see where we're going down, 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 down. Actually, there's 3 ways to look at this. And if this is going down, that means there's not a lot of shorting of the market. This is where people try to benefit from the market going down. Okay, and if this is decreasing, that must mean everybody's positive. That's one way to look at it. Another way to look at this is if this number really starts to go back up, or even is kind of stays where it's at right now, both with the S&P and the NASDAQ 100, if we really start going up like we did in Monday's session, that real spike up that we saw at the end of the day, that was probably not somebody coming in and buying to think, oh, we're going higher from here. That was probably folks in short positions saying, okay, I'm losing money now. I have to get out because the financial requirements are a lot more strict. And this is what I need to do. I don't want to do it, but I have to do it. And then what was the third way that I was thinking about here? So going down, that's positive. It's built-in buyers on the sideline. And I forget the other way that I was going to look at this right now. Okay, maybe I combined the third into what I was saying. And then this is the equity market's reaction to CPI is also getting smaller. There's a lot of front running before CPI has been coming out. And what they try to measure here is what happens after CPI comes out. And it's really been coming down. It's, eh, okay, might be useful, but I don't know if it really helps us all that much. And then these are the recession probabilities. Now, Goldman Sachs, that's the red line here. They freaked out with everybody else. They were probably causing a bit of the freak out. Now they're like, well, maybe things aren't so bad after all, and we're not going to go into a recession. Or if you look at the Bloomberg consensus, this has been trailing down pretty much all along the way with no real spike when it looked like maybe the economy was falling off a cliff. And then market implied change in Fed funds rate. Overall, they have been expecting it to go down, even though there's been a little bit of a blip up. This was more of, oh my gosh, the economy's falling off a cliff, possibly. Okay, so we're just seeing it going up. But overall, it has been coming down, and that's what folks are expecting to have happen. And then when you hear about a company doing stock splits, that's considered to be positive. And during the dot-com boom, there were certain strategies that all people would do is buy stock in companies that announced a split. Usually it's a 2-for-1. So if the price is at 100 after the split, it chops down to 50, but you have double the number of shares. So it's not like you're losing anything. And this tends to have a real positive impact. And we can see this here. It's mostly short term, but it trails off, but it still ends up being positive even out to 3 years later. That's the red diamond that you see here. And I didn't go through any Yardeni charts of interest. There's more on the website talking about that. I just didn't want to spend any time on Twitter. Here is the chart. And now, usually I only show 5 days on here, but I want to go all the way back. This was the big dump day back on August 5th. We opened lower, we found some support, and this ended up being really solid support. We saw this intraday, we saw this on daily charts, we saw this on weekly charts, and it was all coming together, and we were able to bounce up out of that. We did have one pretty monster down day here, but since then, we have been just being able to chop our way progressively higher here, and we continue to go up. And this is that little spike at the end that I was mentioning. This may not have been people buying because they think we're going up. This may have been short sellers having to get out of their positions. Oh, I know another thing I was going to say with short sellers. We may see that decreasing because of the rise of inverse mutual funds and inverse ETFs, where that's a lot less risky. You don't have the same financial requirements when you benefit from the market going down if you get into a mutual fund or ETF that plays the downside, where you have a lot of real exposure if you're just flat going into the market and shorting things. There, that was the third area. Here's our intraday chart. We're pretty much flat right now in the initial overnight session. The futures were flat. We didn't really see anything all that drastic, but we started to come up, and then this is the gain that we saw during the day. This is a little bit of a concern, but we still see the blue line going up nonetheless. We'd like to see growth doing better than value. It's not on an intraday basis where the red line's above the blue line, but the fact that it is advancing is positive. So there's some, you can see this a couple of different ways here. This is looking a little bit better. And again, if we go back to August 5th, where we had the big down day, look at how S&P growth to value has been showing how growth is outperforming. That's why I like to show a little longer term chart here as well, just to get a little bit more of a perspective. End of day charts. We were up more with growth than value for the large caps. We were up less with the mid caps and up a little bit more with the small caps. We want to see things better than what they're doing here, but at least we're going up here with small cap growth to value, mid cap growth to value, S&P growth to value, but nothing really breaking out at this point. This is looking a little bit better here when we take the growth ETF versus the value ETF. We're coming back up and working our way through the rainbow if we can continue to see more improvement here. We're not really seeing anything other than a bounce here with discretionary versus staples. Large cap growth by itself is doing quite well. We were up 1.28%. We're above the 50-day moving average after really coming down almost to the 200-day moving average. So this is continuing to look quite solid just when you look at the chart. We came down a little bit. Small caps had a little bit better day than the large caps, but when this is going up, that means the large caps are outperforming, and that's what really helps the markets to go higher. Keeping an eye on our trend, we're still declining with the ADX because we've seen a recent cross here in the trend that it's picking up. So that is weakening, but we're still above 20. So we are in a weakening trending environment. That trend is positive because the green line is above the red line. Short term, also a weakening ADX, but trends, it looks like it's slowing down a little bit. We can continue to see the green line go up. The ADX would eventually turn and go up as well and possibly switch over to a strengthening trend, but it hasn't done that yet. We continue to drop off with volume, which is a concern. And you notice as we've been going back up, volume has been dropping off. That's a classic technical analysis negative divergence. But we ultimately have to follow price, no matter how illogical that may seem at times. Here is the weekly chart of sentiment coming in at 70.86. We're in the greed area. I would classify this as positive. And then if we get into the dark red area, that's where we're extreme positive. And looking at the insider's transaction ratio, we also look at this once a week. We're actually turning more bullish here as this line has been coming down. And then to go in with that, here's the insider buying ETF. And it's really not performing all that well. It's not doing bad. It's in an uptrend, but it's been chopping sideways more or less for all of 2024. The Ulcer Index is still pretty high as far as this sentiment gauge, but we continue to drop with the VIX. We're still below 15 with the line chart as well as the bar chart, and the VIX of the VIX continues to drop as volatility is also dropping. The momentum of the VIX continues to be down, but seasonally, and I'm just speculating here, we're in August, and this is where we often see the VIX drop after it really spiked up. Are we going to resume going up after we get done with this drop? Which means if this is going up, that's stocks are going down at that point. All right, we're seeing a real drop off here with the equity put call ratio on the daily chart. It was a Monday. Maybe some folks were taking off some hedges. The 5-day continues to go down, and the 10-day is also going down. And when these are going down, that means there's fewer puts, and that tends to be more positive for the market. We're keeping an eye on this. Not a real concern right now because bonds are doing a bit better. But this is the spread between risky and not as risky bonds. This is the chart that we're focusing on here, and mainly the middle area. We want to see this continue to go up if the risk seems to be coming out of the bond market. We continue to fall with this fear gauge and this other fear gauge that we follow, so we're seeing confirmation there. We're still assuming more of a risk-on posture. That means folks are getting into the high beta stocks, the ones that tend to outperform when we're going up, rather than the value or more defensive stocks. And we continue to be quite low here, the lowest reading that we can see on this chart with the volatility risk premium. So we have the Ulcer Index that's still looking really high, and we have the volatility risk premium that's looking pretty low, and then the VIX has been coming down as well. Advanced decline line, seeing some improvement here, but also something that we've been watching that's a negative divergence. We're breaking out based on price. We're improving based on volume, but we have not been able to break out above this previous high. That's the negative divergence. Looking better here, seeing more new highs and virtually no new lows. So our 5-day is now turning up, and our 10-day is also starting to turn back up. This is another internal measure that shows us internally the S&P is looking pretty good. We're getting a little extreme here with the 19-day advanced decline ratio. That's the blue line, but we're still positive with the 39-day, which is more intermediate term. And here's another breakout of the advanced decline ratio based on 19 days. Extreme with price, and we're also getting extreme with volume here. And a couple of different ways to see this. This is a smart money indicator. We are positive. Accumulation distribution is above the moving average, and now the red line is starting to turn back up. Now, down here is a thing called the boom indicator, which attempts to measure how far above or below are we from the moving average. This is suggesting that we're getting kind of far away from that, but this isn't a true representation of what's happening here. Instead of just taking the indicator and subtracting the moving average, I don't have that capability in stockcharts.com. I can do it based on stocks or indexes, but I can't do that based on indicators. So I had to come up with kind of a proxy, which I call the boom indicator, which uses a MACD to try to simulate what is happening here. And this suggests that we're getting a little far away, but at the same time, we are positive with this indicator. Chicken money flow has not switched over positive yet, but the red line's going up, so we're treating this as positive. It'll be confirmed positive if we continue to go up and turn green. We're getting a little extreme here. We're hitting this initial extreme positive reading with the chicken oscillator, but it's still positive. The vortex continues to be positive with the green line on top and advancing. Looking pretty good here with the cumulative advanced decline line based on price. That's breaking out, showing an improvement, but not breaking out yet based on volume. And when we look at the S&P and compare it with the NYSE advanced decline line, both are looking pretty good right now. The red line above the S&P index, even though they're on different scales, I always like to point that out. When the red line is above, that just means there's more broad market participation. We're showing some improvement here with the 10-day average of the S&P 500 highs minus the lows. We're bouncing back up. It would get even more positive if we could work our way back above this green line. That would suggest longer-term momentum. We're looking positive here with the NYSE new highs minus the new lows. Just the daily score is above 0. That's positive. We're showing an improvement here with the cumulative NYSE advanced decline line. It's going up. The moving average is still going down, but if we stay above this, that will turn the blue line back up. When we look at the regular NYSE advanced decline line, we are breaking out and looking quite positive. Here's another NYSE advanced decline line also looking quite positive. And then we break this down, NYSE common stock based on price, breaking out above these previous levels and pretty much matching the previous levels here when we look at this based on volume. But both of these are positive. It would be more of a confirmation if we can see volume continue to go up. And then we look at the broad market of the 5-period moving average of the highs minus the lows. We're back above 0 after we had dropped to negative. This is more positive and a little bit longer term here. The advanced decline line looking good with the NYSE common stock, S&P, mid caps, and small caps. In our short-term chart, we were able to stay above this pivot point here. We're above the 50-day moving average. We're not back to an all-time high yet. We're just a little over 1% away from this all-time high. We'll have to see if we're able to break above that and set a new all-time high, or are we eventually going to exhaust ourselves and maybe what Chair Powell says in this extreme positive reading, is that going to end up dropping things down before we get to the all-time high again? And on the bottom, this is a bit of a concern. You can explain it logically because it's summertime. Also, it's a concern because we've been going up on a decrease in volume. And we're getting a little extreme when we just look at the S&P and the 20-period exponential moving average. Still looking positive with the 50 and the 200. The Stochk RSI, a short-term indicator. All of our short-term indicators are now extreme positive. The Williams percent R is extreme, the CCI 14, and it wasn't on the list, but the CCI 20 is now becoming extreme. We're extreme with the 20-period boom indicator here. We're getting kind of far away from that 20-period moving average. Still looking positive with the 50 and looking better with the 200. The condition of the 20-period moving average trend here, looking better. We're seeing the lines going back up and prices above both. Here's our simple and exponential moving average. The blue line's crossing above the red line. That's the exponential moving average, which is in blue, and it moves faster than the red line, which is a simple moving average, and price is above both. So our short-term trend is looking pretty solid. But we're looking rather extreme in the short-term stochastics, intermediate short-term stochastics, and we're crossing over and looking positive with the longer short-term stochastic. The force index still hidden around this Keltner band right now. And that's a little extreme, but it is positive. And for a number of days now, we've had the rate of change going back 5 periods because it counts back 5 periods and then measures where we are versus 5 days ago. And this is also suggesting good momentum. But when we get above this blue line, that's a little extreme positive. And the 10-day, man, just it finally was able to calculate back far enough excuse me, just to shoot this baby higher. And we haven't seen that reading as high on this chart, but this goes back just about a year. We're not extreme here with the standard deviations. We're right on the border between the +2 and the +3 channel. If we go up into the +3 channel, that's when we're starting to look extreme positive. Intermediate term, balance of power coming up, not extreme yet, but it is positive. We are still extreme with the CMB composite. We're extreme positive with the Connors RSI. The condition of the 50-period moving average is improving, and the blue line and the red line are starting to turn back up. If we stay above this, the red line crossing above the blue line would be even more positive. Here's a simple and exponential moving average study. Still a ways to go for the blue line, which is exponential across above the red line, but we're seeing where price is above both. So the intermediate term trend is positive. And here are all of the moving averages. It'll be even more positive if the 20s, which dropped below the 50s, can get back above the 50s again. That would smooth things out and make the trend look even more positive. We're coming up here, we're actually exceeding the highest high value here. So this is quite positive. And we're still brown right now with the go, no go after switching over from negative. The TTM squeeze has now gone positive here. So that's looking good on a momentum basis. We're still going up with the standard deviation as we've really been climbing pretty fast here. Again, as I like to say, standard deviation measures speed, not direction. Ease of movement has now crossed over to positive. The Arun's it's on vacation. It's at the beach, not really doing too much. Now, we're looking a little extreme with the S&P McClellan oscillator, but this could also suggest good momentum, but we also want to be aware of this. This could also point to exhaustion. We're going up with the summation index based on price and volume, and they are confirming each other. As I've also been pointing out, we noticed these longer-term negative divergence as the S&P was going up, and we're seeing lower readings here. What we're focusing on right now is that both price and volume are going up together. And we're going up, but not extreme with the NYSE McClellan oscillator. So we're going up with the summation index based on price and volume. Momentum is starting to switch over and look even more positive with the PMO. We're also looking positive when we break it out based on price and volume. This is where we're looking a little extreme with the PMOs that are rising. It's getting a little too positive there. Again, could suggest exhaustion, but could also suggest momentum. We're going up with the buy signals and we're going up with the PMOs that are above zero. We're extreme positive here with the Swenlin trading oscillator based on volume. Now, this is kind of encouraging because volume had been lagging behind price in the S&P. And to see this actually doing a little bit better is kind of encouraging. We're also continuing to be positive based on price. And we're turning positive now with the slope oscillator. We're crossing above the midpoint and we're above the moving average. Now, we had already gone positive once we crossed above the moving average. This is more of a confirmation of things being positive. And the MACD is crossing above 0 too. So the slope is short term, where the MACD is more short to slightly intermediate term. So this is looking better as well. So with the short term, we're looking better here. Even the TSI is crossing back above the midpoint, and the MACD, the PMO, and PPO are showing a lot of improvement. We're just getting ready to cross over the moving average with the tricks. We've already crossed above the moving average with the KST, and these are our longer term oscillators. Copic curve is positive, another momentum oscillator. We're positive with the Elder's impulse system for the S&P. We're positive with the parabolic SAR. We're still negative on the weekly chart, but we're positive here on the daily chart. We're getting a little extreme here with the Sean trend meter, but that could also be taken as positive. The bullish percent index continues to advance and not extreme right now. This is suggesting good buy signals when you look at point and figure charts inside of the S&P, all the stocks that make up the index. Also looking positive with the NYSE bullish percent index and looking positive with the NASDAQ 100 bullish percent index. The money flows above 50 and advancing. That's positive. The ultimate oscillator just barely starting to come into an extreme positive reading, but it's still positive nonetheless. We're above 50 and going up with the 14 RSI. We're going up. If we continue to go up, we might start to get extreme with the RSI based on 9 periods. On balance, volume continues to be positive, and the moving average is now turning back up. Again, two ways to look at this. We're starting to get extreme with those stocks in the S&P above their 20-period moving average, but this could also suggest good momentum. When we look at our study, we're above 70 now, which could also suggest good momentum, or it could also mean exhaustion. We're going to have to watch to see which one plays out. We're looking positive with those stocks above their 50-day moving average, 100-day moving average, and 200-day moving average. And we're still waiting for the third part of the signal here with the mass index. It hasn't triggered yet. And we're turning back more positive here with the Ichimoku cloud. The blue line is barely coming back across the red line, or the green line, which is much harder to see. It's actually been going up quite well. Where the negative holdout was that the blue line was below the red line. Well, now that's starting to improve as we're breaking out above the Ichimoku cloud. And we're looking a little better here. We're still above this 50% fib extension level for the S&P. This is looking good too, with our weekly chart of the S&P off to a new start here after coming down to this R1 level. This was one of the longer term support levels that I mentioned earlier on when we hit that low on August 5th. We've been able to bounce up off of that, and we're above this R2 level. So this is still looking good for now. Now, we could potentially be coming up to a cycle day based on 50 days. I don't put too much importance into this. I know there's a lot of perma bears who have these magical cycles and they use stars and astrology and all this voodoo stuff, according to me. But we are coming up to the point now where a new cycle could be beginning. Sometimes that meant something, sometimes it meant nothing. Then looking at our Heikin-Ashi chart, we are looking positive with the trend. We're going up with the Kagi chart. We're going up with the Renko chart. We're going up with the three-line break chart. And just enough of a move up here, above 5,600, to put a new X in here on the point and figure chart. We're still working off of a double top breakout. Actually, this is a new signal. We had been doing a low pole reversal. Now it's looking like since we're breaking out a bit here, it's actually changed its signal. And we're looking a little extreme here with the 150 moving average. Again, also could mean good momentum. And for those of you that, I don't mention this all that often, I put a 50-period moving average up here, but I really don't look at it. I just use it more for reference. Mainly, I'm focused on the 150 and 200, and we're getting above the red line here with the 200 as well. And then this is a shorter term look at the rate of change going back 200 periods. And then I have a longer chart where it's not looking quite as drastic. But since this has kind of mattered before, we want to keep an eye on this shorter term chart. Then we are positive across the board with the Keller market model on all time frames. We're still negative with commodities and the dollar across all time frames, where stocks and bonds are positive. And the decision point scorecard is positive across the board. And saw a little bit of negative. This is that little dip down that we saw right after the open, because we read these charts from the bottom up. And then NASDAQ was able to climb back up. We had the NYC summation index crossing above its 20-day. So, showing some improvement here. And then oil keeps dropping, which actually could be positive for the market. And it's positive from a geopolitical standpoint, but they have it in red here because it declined. And then here's where the S&P was able to get above 5,600. And all the sectors ended up being positive, led by tech and discretionary and communication. These are the big three growth areas. We want to see this continue to happen if we're going to go up with the market. These are the real leader areas. Where we're seeing things like staples, those are defensive. And that was up, but not up as much. Healthcare is another defensive area. Utilities were kind of a little bit unsure about that. It also ended up being up as well. And when the red line is above the S&P bar chart here, that just means the equal weight is outperforming the S&P. Yes, they're on different scales. This is another way of showing that as well, where we continue to go up, where we're seeing the bigger stocks leading. So that's why this ratio is going up. But we still want to see that red line looking pretty healthy on the previous chart. This is another way of looking at that. When this is going down, that means the equal weight is underperforming the S&P, which is not necessarily terrible, but we don't want to see this really fall down the way it was before. We want to see more broad market participation, especially across the S&P 500. The Dow is looking pretty positive, still above this pivot point and in an uptrend, but not in an all-time high. We're positive with the Elder's Impulse system for the diamonds. We were able to close above this pivot point for the NASDAQ, and we're above the 50-day moving average. We're also above the 50-day moving average with the NASDAQ 100 and able to go above this pivot point. Now, what I've noticed over the years is the NASDAQ and NASDAQ 100 pivot points can be on the daily charts, can be pretty influential. If you go back, you look at these dashed lines, sometimes it really meant something, sometimes not so much. So we just want to keep these in mind. And the fact that we're above this, and this is kind of the line in the sand for August between positive and negative. The pivot point is the middle. And when we're below that, that means we're down for the month. When we break above it, that means we're switching over to positive. So we'll have to see if we can hang on to this. And we're positive with the Elder's Impulse system for the Qs. The momentum, we're not at zero yet here with the NASDAQ 100 momentum, but we are looking positive since we're above the moving average. We're above the moving averages here, and we close pretty much at the high for the Qs. It would be even more positive if the 20 could come back eventually and cross above the 50. And we're gaining some ground here. We're still above the 23.6% fib extension level for the Qs. The small caps still kind of range bound here. At least it's a little bigger range right now. But they were up 0.86% above the 50-day moving average with the small cap index. When we look at the Russell 2000 small cap index, we're above 50 with the RSI. We're above the 50-day moving average, and the momentum is trying to turn back positive. And we continue to look positive with the small caps with the Elder's Impulse system. This is a ratio between small caps and the tech sector. This was down, and that just means the tech sector is outperforming. When we see a longer-term trend like we have been, that means the tech sector continues to outperform. The mid caps coming right up to this pivot point here, and then we're not able to close above that, but we're positive with the Elder's Impulse system for the mid caps. And then Wilshire, another broad market measure, climbing further above its 50-day moving average. And the total stock ETF here is also climbing further above its 50-day moving average. And the staples to tech ratio, if this is going down, that means tech is outperforming staples, like we had been seeing lately with the more downward sloping trend. This is more positive for the market. Financial sector still looking pretty good here, up over 0.5%. The FANG index is still above its 50-day moving average, and we're able, at least for right now, to reclaim these trend lines that had been acting as support. Well, we got those back now. So that's showing some improvement for the FANG index. And Apple was actually down a little bit, but above its 50-day moving average. Amazon was up 0.33% above its 200-day moving average. Meta or Facebook was up 0.33%. Microsoft above its 200-day moving average up about 0.75%. Google was up over 2.25% here above its 200-day moving average. NVIDIA, they're going to be reporting earnings pretty soon. It's like the big party that everyone's waiting for now. It was up 4.33% and back above its 50-day moving average. Tesla also above both the moving averages and up over 3%. Netflix was up 2.15% above its 50-day moving average. So when we see all these charts looking better, it's no wonder that the S&P index and the NASDAQ 100, for that matter, are improving and are looking better. This is something that we're keeping an eye on. We're not really sure if this is positive or negative. We have the S&P on top, and then here's the Home Builders ETF here. And you can see they both have been going up, but the Home Builders ETF is really underperforming. What I'm paying attention to is down here on the bottom. It's the correlation between the top chart and the middle chart. And sometimes this is diverging, but we're not sure if that's positive or negative right now. Is this going to pull the S&P 500 down, or are the home builders going to be pulled up? Oil continues to drop, and that kind of helps things geopolitically because that's where we're focused on this for right now. And the dollar is still hanging on to an uptrend, but it has been declining. We're getting back into the 101 range. And we look at the strong correlation between U.S. stocks and world stocks, both in the short term and in the longer term. And we continue to drop at the 10-year yield. We are going back up with the 10-year based on price. We're looking at a bond to stock ratio. As this is going down, that means stocks are outperforming. When everybody started freaking out, we saw this really going back up. Now it's continuing to come back down. And we're also seeing a little bit of a shift here. Riskier versus more conservative bonds. We had fallen below the rainbow as folks were thinking maybe the economy's falling apart. We better get out of these junk bonds and get into more conservative bonds. Well, they're kind of rethinking that a little bit now, but we still have not gone back up into the rainbow. And we're looking at the soft landing scenario. We're actually starting to come back up out of the rainbow after being pretty deep inside of it there for a while. And the soft landing just means they're not anticipating a recession. We look at a broad market measure with short-term bonds coming up out of the rainbow. Another broad market measure with 3 to 7 year bonds coming up out of the rainbow. The tech sector, the 3 to 7 year bonds, not quite out of the rainbow yet, but showing an improvement. And the Qs, the 3 to 7 year bonds, also not quite out of the rainbow yet. And home construction starting to show some improvement after it had been under some pressure lately when we compare it to 3 to 7 year bonds. And we're seeing some improvement here, but not real gangbuster improvement with Qs to S&P. We're still coming up to the moving average, which is declining with discretionary to S&P. We're a little bit above the moving average when we look at large cap growth versus large cap value. So the large caps above the moving average, slightly above with the mid caps, and just a little bit above here with the small caps. We're going back up with the S&P to utilities ratio. This is more positive for the S&P. Where when this is going down the way it is right now, this is also more positive for the S&P as it shows that staples are underperforming. So what's our outlook for Tuesday? Just keep in mind that on Friday, Chair Powell will be speaking at Jackson Hole. That can really rattle the markets if he says something either positive or negative. And then retail sales reports are going to be, or earnings reports are going to be coming out this week from Lowe's, Target, TJX, Urban Outfitters, and the Dollar Tree. Because we had the retail sales report come out last week. It was stronger than expected. The market really liked that. So we'll have to see if that feeds over into the earnings. The technicals are positive, and not only in the short term, but we're starting to become a little extreme positive in the intermediate term. We're not going to have any economic reports on Tuesday, and then all the different crazy things going. I suppose I should take the France Olympics off of here since they have now completed over a week ago. All right, so no economic reports on Tuesday. We're going to get the meeting minutes on Wednesday, and probably one of the bigger reports is going to be the weekly jobless claims on Thursday. New home sales might have some of an impact on Friday. And here's another look at the economic calendar. Seasonally, we're neutral to negative. No real edge here. Now, we're also in the second day of the week after options expiration, where we do tend to be up more than down in August. 65% up, 35% down. But when we look at August 20th, just a little bit under 50%. So it's kind of a flip of the coin here. And Tuesday is also kind of a flip of the coin based on what happened in 2023. But we're seeing a little bit of negative seasonality coming in here when we're looking at this during, and I guess this is all years here. So this could suggest some weakness. And also wondering if we're working our way back down or starting to turn back up here when we compare 1968 to 2024. And this is the comparison week because we have the Democratic National Convention in Chicago. That's where it was in 1968. And there were all these riots and people going crazy and riot police and that is all nuts. And there's lots of protests going on in Chicago now that are not necessarily pro-democratic. They don't really like what they see happening. So we'll see. Let's just hope things can stay under control. That would be really nice. And then looking at when the incumbent president is not running for re-election, we do tend to perform well even when that happens. But we want to keep a mind open to September. Historically and seasonally, this has not been a very good month for the market based on this chart, nor is it based on the next chart. And when we take August through October together, and a lot of this comes through in September, where we've seen October be some of the best months and the worst months because all the big crashes have occurred in October. But September is usually the one that, I don't know, people just aren't very happy or something. But August tends to look good, especially during an election year, but September is negative no matter how you look at it. So the warning signs, we're keeping an eye on all these different defensive sectors, staples, utilities, and healthcare. And energy is kind of a variable right now. Why is that going up or down? Is it due to geopolitical events? And we'd like to see growth to value and discretionary to staples. They're looking better, but they're not really leading anything right now. And I don't know whether this is positive or negative yet, but the home builders study is diverging from the S&P 500. Pretty long list on the positive side. We have the equity put call ratios 5 and 10 period charts going down, accumulation distribution, which may be extreme positive now. The Chaikin money flow is continuing to improve, but it hasn't quite turned full-blown positive yet. The Chaikin oscillator, a little bit extreme positive, but when we take these three together, we use those as our smart money indicators. They are positive. The advanced decline lines looking pretty good right now. The S&P, which is a little extreme with the McClellan oscillator, but still looking positive with the NYSE McClellan oscillator, and the summation indexes are positive. The Swenlin trading oscillator, but we're getting a little extreme based on volume, which could also be kind of encouraging since we have below average volume. The parabolic SAR, our oscillators are turning positive. When we look at the bullish percent indexes for the S&P, NASDAQ, and NYSE, they are positive. The ease of movement, a new addition to this list. It's finally here on this side now, the positive side. The money flow, the ultimate oscillator, the Copic curve, and the vortex are all positive. The financial sector is holding up quite well, and the momentum for the NASDAQ 100. So our conclusion, we're positive, but we're becoming more overbought, and we're seeing that more in the short and intermediate term. You can also say a little bit of that in the long term. So we're overbought in the short term, becoming overbought in the intermediate term, and we do have some indications in the longer term there. Thank you. I hope you have a really good day, and I will talk to you in the next video.